Hey everyone, when we talk about fund performance, we usually focus on the mountaintop, the total return. But clients don't live on the mountaintop, they live in the valleys. A drawdown is simply the ouch factor. It's the distance from the highest peak your fund or your account ever hit to the lowest point it fell before starting to recover. Now, if your client had 100,000 and dropped to 80,000, that's a 20% drawdown. It's the real world measurement of how much pain an investor had to stomach to get their gains. Why does this matter? Because of a famous study by Kahneman and Tversky. They proved that humans are loss averse. This means losing money hurts twice as much as winning feels good. Now, in the world of fund management, some expert wealth advisors will argue that you aren't paying a manager to beat the market when things are great. You're paying them to not perform as badly when the market crashes. Research shows that minimizing these valleys is often the best way to keep a client from making a big mistake and selling at the bottom. Is drawdown the perfect stat? Let's look at the debate. On one hand, it's easy for clients to understand. Terms like alpha or beta may not always sink in, but they understand the worst 18 months. It helps you choose funds that might have lower highs but much shallower valleys. Now, on the other hand, it's backward looking. Just because a fund didn't drop much in 2023 doesn't mean it won't in the next crisis. Also, it doesn't tell you the recovery period. How long it took to get back to the peak is just as important for your investors' nerves. Let's see how to use this live on Finominal. Imagine you're comparing a Victory Capital fund versus a fund from Pacer, and you're doing this for an investor who's terrified of another 2008 style crash. So the first step is let's drop both tickers into asset comparison tool. Now let's go and look at the maximum drawdowns in this chart. Now we can see the last few years against these two funds from Victory and from Pacer. The other thing we can do is we can use the scenario analysis feature and we can actually simulate the Lehman-like bankruptcy to see which fund would have the bigger ouch factor. And there it is. Now this is possible because Finominal's proprietary factor model allows us to capture the fund's exposure to allow us to view the replicated returns. Think of it as a time machine for risk management. So now that we looked at drawdown and looked at probably the worst crisis here in 2025 for both the funds, we should compare it because we do observe similar risks to the returns table. And now I'm just eyeballing it, and let's just look at it from a yearly perspective. Between 2026 and so on, it's clear the Victory Capital Fund outperforms on a relative basis over the last few years. Now, if you do want to quantify it, you can calculate a statistic called the return over maximum drawdown. Now, this ratio helps you understand how a fund's return justifies the risk of potential losses. Now, to sum up, when you're working with your client, you can say something like, look, this fund might have slightly lower returns, but in a crisis, your client stays in their seat because our drawdown was 10% less than the peer group. The key takeaway is returns tell you how much you made, but drawdowns tell you if your client will stay long enough to actually keep it. Thank you for exploring this use case with me. Please subscribe as I explore more workflows that may help with your client narratives. Send me a note if you're interested in the paper or looking to experiment with something on the platform. I'm John Regino of Finominal. See you again soon.